quick summary of this webinar. FuturePath Trading and TradeNavigator together put this webinar together, and we asked Linda to be part of it to have some fun and ask Linda questions. We're going to get into a little bit about Linda in 5 minutes, and then we'll get going. But first, let me introduce myself. You see my history. I'm not going to spend too much time on me. I just wanted to leave that up so that you have an idea of my background. I'm sure that you had a chance to read it. Glenn Larson, TradeNavigator, is also sponsoring this webinar. We're doing this together. So FuturePath Trading, my company, which is a brokerage firm, and we offer 5 different FCMs, and all of them we work with TradeNavigator on all those FCMs. TradeNavigator is an awesome trading platform. It's one of our favorites. We offer our own and TradeNavigator, but those are our top choices. TradeNavigator has all kinds of great studies and flexibility with programming and different tools that you can use. I'll let Glenn talk about that later. Meanwhile, Glenn will be offering, as well as FuturePath, a special deal at the very end of this for those users who are on board and chose to join us. Okay, let me just throw this risk disclosure up here. It's just part of our industry that most futures traders have seen these disclosures before. But it's really important that what you're going to see here today is most of its opinion, and there'll be some trading strategies or some different systems mentioned, and all this other financial stuff and trading tips and tricks. It's really an opinion. There's no guarantees, and of course, futures can be very it can be risky because of the amount of leverage, but it is a great tool. I've been in the futures business for 41 years. I pretty much did everything you can imagine in this business, and I'm still here, and same with Linda. All right, so today, this is something different. I don't think we've ever done this together. Linda is going to answer a bunch of questions. We asked the audience ahead of time to send in their questions, and I have to say, I was a little overwhelmed. There's quite a few questions. We're going to try to go through them all, and we're going to try to take some at the very end. And any questions that, for instance, that we can't get to, you can always send them in, or we'll try to answer them at another time. So this is Linda's history. Just a quick note, I've known Linda since 1991. She was a client of mine when I executed on the floor of the exchange, and I had a company there when we took that brokerage off the floor. Linda and myself, we were friends for 15 years, and just to make a long story short, we became closer and closer, and in 2008, we actually decided to get married. So, full disclosure, it's been a fun marriage, being in the same business. We have a lot in common. So let's go. I'm going to leave this up here for a second, and we're going to turn this over to Linda. Let's see if Linda's on.
Hi, gang. Can you hear me?
There we go. Can everybody hear her good? I certainly can. And I think the way we're going to do this today, Linda, is I'll ask the questions that were sent in, and you can answer them the best, to your ability. And hopefully some of them are easy to read, but I'll go through it. And so we'll take one question at a time. Linda will take over, and she will probably be showing her screen too as well.
Hey gang, just so you know, here's how we're going to rock and roll it today, because I know that we got a lot of questions and I wanted to get the most amount of information to you in the least amount of time, so we can just snap through this, because I'm sure if you have other questions that come up, we'll have plenty of time to take them. So many of you emailed your questions in ahead of time, and no cheating here. These are all your guys' questions. I didn't make any of this stuff up, okay? And so I had Damon sort of group them into 4 main categories here, just some stuff so that it would really move along at a nice pace for you. And some are just pretty direct questions on some individual markets, and then more on practicality, indicators, you know, how I do my modeling, a couple things like that. C is more psychological, you know, such as what do you do when you've got losing periods and so forth and so forth. And then D, just back down to process and organization, and a few more general questions. So feel free to post your questions as it comes along, because I'm sitting here in front of my computer, can easily call a chart up, no problem whatsoever. So I'm just going to show this and see if you can see my stuff here. All right. Can everybody see that? I don't know. I've got a little sardine guy up there.
Did you hit the share button?
I did.
Okay. There we go. Okay.
All right. Rock and roll.
So does everybody see that little sardine?
Okay. So I can just slide stuff here and you can see our smiling faces. Is that working? Yep. Right. Okay, it is. All right. See, I had to post a picture of in our younger days before we all had, you know, gray hair. And so on some of the questions about modeling and testing, and I just wanted to give credit to Nigel, who you see here in the middle. I wrote a whole chapter on him in my book, Trading Sardines. And he was just an ace at doing the modeling and the testing. And so I have to give a lot of credit to him. And you can see my sidekick here on one side, and me on the other. This is when we first moved our offices from Florida up to Chicago. And okay, so I think we should rock and roll here. Let's get it going.
Okay, so let's rock. I'll ask the questions and then we'll shoot. The first question: how do you trade the bond market? I know the direction after the noon. I'll finish this real quick. I know the direction after the noonday can sometimes predict market direction. But what else? Indicators don't really help. The market does move at 7 a.m., but in what direction?
All right, here's I love the bond market. It's always been one of my favorite markets from day one, the S&Ps and then the bonds. Lately, it got pretty crummy trading as we consolidated in a range, and the volatility just got squished. In fact, the volatility in the credit markets actually dropped down to the lowest level since 1964. So it's not much fun to trade when it's doing stuff like this. With that said, I've got a lot of questions about different indicators and different time frames, and the bonds are tricky if you're going to look at a 5-minute chart or a 15-minute chart. Here's what I try to do. I do 2 main things with the bonds. First, I'm always looking for where can I go in and make a trade, on which days rather, where I've got the most potential for a trend day. So I'm particularly keen at looking at the bonds after you've had 2 to 3 days up, and I'm looking for a shorting opportunity, or 2 to 3 days down and I'm looking for a buying opportunity. That's when you're range trading. Or do we have a breakout trade where you've got 3 bars of price overlap? And you can see we actually had that, of course, before the FOMC meeting, which is pretty typical. Once you have an upside breakout like we had there, and you can see that we made these new momentum highs. My cursor showing there? Yeah. Oh, rock and roll. Okay, so you can see this is my little 2-period rate of change. If we start making new momentum highs and new price highs, then we're in a condition which I've modeled a lot, and I know many of you have seen on my YouTube videos, of extended runs. And once you're in an extended run, or something where you've created this tremendous upside momentum, any trades that I do, if I'm looking for a short trade, it would be a scalp only, and mostly you're better off just waiting to buy the dips. So just to summarize, I'm usually looking for a daily bias. Do I have a bias from a low to high or a high to low? And trust me, there's a lot of days where I don't have anything. And then let it go. Now, with that said, I love tick charts. I hate 5-minute charts. So with the bonds, I like to look at 2,000 tick, 10,000 tick, stuff like that. And you can see here, pretty much I'm either looking for some type of momentum buy divergence. You can see as we came in this morning, 1, 2, 3 pushes down, and I've got a good entry there. Or I'm doing a little bit more chart formations with the tick charts, flags, consolidations, ABCs, pretty basic technical analysis. The second thing I will mention with the bonds that works best in my book is time of day functions. And you will see 80% of the time when Europe goes to lunch, right around their lunchtime is the start of our AM session. I use 7 a.m. Central Time for my start time. And very often you will see these bonds make an inflection between 6:30 and 7 a.m. Central Time. They tend to have a rally, I'm speaking in gross generalizations, up until noon. So that's the sweet spot of the morning there. In general, if that market starts making new highs after 12 noon or new lows after 12 noon, it's pretty much going to be that basic trend for the day. So those are just rough guidelines. So to sum it up, I try to find just the trend for the day, if there is such a thing from the daily candlesticks. I look at my time of day functions, and I like tick charts just for highlighting the little small chart formations. Okay, next question.
What can I learn from the yield curve, and what does that mean?
I don't know. I'm a trader, okay? So I don't look at the yield curve. I really don't care. There was a lot of media hype here on the yield curve inverting, and I think they were commenting on the 3-month and the 10-year yields, okay, which really is sort of a bogus measurement. You should either be looking at the 2s or the 10s, in my opinion. And Ned Davis has said for years and years and years that the only thing that matters is the 3-month and the 30-year. Now that's Ned Davis, and of course that has not inverted. So I don't think it really means anything. I mean, if you look at the statistics, they talk about how a recession might occur 19 months from when the yield curve inverts or something like that. But honestly, guys, I mean, that would just mess with my head too much. I'm looking for opportunity for the day. I'm looking for, is there an opportunity for the next couple days? I'm not going to read a bullish or bearish bias into any of that. I'm just going to follow the market's footprints and see if there's a supply-demand imbalance. Okay.
Wondering if you have found new ways to use the 310 oscillator. I still look for an entry implementing first cross method with good success on the ES.
Okay, just for those of you who don't know, the 310 oscillator is actually this oscillator that's plotted on the bottom of this tick chart. And it's very similar to if you were looking at a 9-period stochastic. So an oscillator is an oscillator. It's a derivative of price. So there's no new ways to use oscillators. They're just highlighting what is there in the bar chart anyway. So it's basic chart formations. The problem is that when you go down to lower time frames, such as 5-minute charts, there's an incredible amount of noise. Very noisy, and you might only see 2 or 3 clean patterns a day on a 5-minute chart with a 310 oscillator. So really what I do is I use it as a crutch to show what is there in the bar charts anyway. So for example, on this chart, the tick chart of the bonds, you could see this little momentum divergence that was forming there. You can see this little bit of a pullback. Mind you, this is a tick chart, so it's sort of crummy. When we made new momentum highs out of this sort of ABC consolidation here, you could kind of get a feel that the pullback in the oscillator there, but you could see the same thing in the bar chart anyway, that we were consolidating sideways and not giving up any ground. So it's just one more tool. A pullback to the moving average is a tool. I can't trade off of an oscillator, but I do use it for confirmation, and especially on the daily charts, it's a great way to process a lot of data in a very quick period of time. So I don't think there's ever going to be anything new under the sun in the bar charts, and therefore I don't think there's really going to be anything new under the sun with an oscillator.
Which time frames do you trade for the ES and NQ products?
Well, I do the same thing with the S&P that I do with the bonds. I'm always going to try and approach it as, is there a play for the trend for the day? Is it going to be a low to high day or high to low day? And trust me, I do not get that correct all the time. But in general, there's, this concept Taylor put forth of, the bulls have their turn and then the bears have their turn every 2 to 3 days. And you can use some pattern recognition. You could use it 1 20-minute charts, 2 40-minute charts. So with that said, once I have a general bias, like for example, this morning when I came in, okay, actually I do my homework after the close yesterday. So after yesterday's close, my bias was that it should be a buy date. And the reason was our 2-period rate of change had pulled down 2 days. These little 2 dots sort of means that it gave it everything it had to the downside. We pulled back to the moving average. So I came in this morning with a buy day bias, but we were already up so much. So therefore, this is Taylor's words, not mine. I'm like, okay, it's a buy day, but highs made first because we were already up too far off of yesterday's lows. So I shorted first, and you can do that. See, it doesn't matter buy day or sell short day. It's buy day short. It just kind of tells me where I am in the sequence, not to conflate things too much. But I like tick charts a lot for the bonds and the S&Ps too, and they keep the overnight data super clean. So for example, I'm just going to pull this guy right down here. And you can see this is a tick chart on the S&Ps. I like 4,000 ticks. I like 20,000 ticks. I like, 40,000 ticks. It really doesn't matter. I'm just, I like having 2 or 3 of them up. And again, I'm just looking for the little double tops, the little chart formations. I'm really basic, guys. I'm really basic in that. Is there still a bull flag? Do we need to test? Did we do a test and a failure? Then are we going to come back down to the previous range? It's pretty basic. You can see the momentum divergences here. And with that said, on my trade station monitor, this is CQG here. Just to give you an idea, I always have one monitor up, and it's got the 5, 15, and usually the 30-minute charts up. And I like to look to see, you can see the 15-minute here sort of had a quasi-buy divergence. It wasn't very clean because the volume was super light today. You'll always have better chart formations and setups and trading conditions on heavier volume days. Today was just a super light volume day, so it was a little bit more challenging. But I like to look across all markets to make sure that everybody's participating. Otherwise, we're probably not going to get too far. So if you see, for example, the NASDAQ being super strong, but the small caps not following, it's probably not going to get too far, and vice versa. Okay, so I covered what time frames there.
Okay. All right. Do you believe that all good systems are fractal in nature? In other words, the performance should be similar regardless of the time frame, daily, hourly, weekly, etc.
Absolutely not. There's several reasons why. Some systems are based just on anomalies for one particular market. Like we have a system that we do in the S&Ps. If they gap up or down by a certain amount, that wouldn't be appropriate to do on other time frames, nor would it necessarily be appropriate to do on other markets. The second problem is that different time frames have different noise levels. To give you the most extreme example, you wouldn't trade a trend following system on 10-minute data, but it might work fine on daily data. Same thing, a volatility breakout system, that's just strictly meant off of daily data. You can take that concept of breakouts and apply it to intraday time frames. But no, I don't believe that good systems are fractal in nature. You can have principles of price behavior that work on all time frames, all markets, such as momentum divergences or breakouts, or momentum precedes price, trends go further than we think they will, these types of general cliche sayings, but those aren't systems.
All righty. Do you incorporate the element of time in your trades? For example, if a minimum profit target is not achieved by X number of bars, when is it a time element useful or not useful to incorporate in a trading approach?
Time elements are a fabulous concept. In fact, when we were doing all our modeling, almost all of our models, we also tested with a time component, such as initiate your entry. What happens if you exit after bar 1, bar 2, bar 3, bar 4? And what happens when you do that type of modeling is you end up with an extremely durable and robust type of result. It's really similar to actuarial tables. And the thing that makes it work is that you need to have a relatively large sample size. So in terms of, let's say I'm a short-term trader in the S&Ps, if I put a trade on, I expect it to catch or start working relatively quickly. I don't want to be in something and have it go nowhere. It's not doing me any good. It's not doing my bottom line any good. And it just takes up my time and energy watching a dead market. So I have no problem getting out of a market, and then if it comes back to life, get in again. I generally don't put profit targets on my stuff. I'll have an idea if we're going to go up and test a high or we're going to go to a certain level. But you know, if it's a relatively range-bound day with lighter volume, I'm not going to give it too much time because the odds that it gets legs and really travels are pretty remote. So time is a great concept for many people if it works for you, and I would just say try it. You know, I have a lot of feedback from people that get too antsy and they don't stay with their trades long enough. You know, get one of those little egg turner things and turn it up or down on your desk. I'm sure they have one on the internet that you could do just for fun. Okay.
As a general rule, how do you prefer to exit profitable trades? Scale out or profit target, or when you exit a losing trade, mental or a physical stop?
Well, you know, how do you prefer to exit a profitable trade? Okay. Here's something that you need to think about in your trading. What was the play? Why did you make that trade in the first place? What is it that that trade was based on? So for example, we've had a few good seasonal trades in the market recently in particular commodities. And, you know, the best thing you can do is try to stay with that trade as long as possible, either trailing a stop or a lot of times what I've done is I'll sell out when I think there's a good spot to sell something back, but I'm usually looking to rebuy it then. And I don't have a problem if I sell something out, rebuying it, if I think that it's still got more in it. I don't put profit targets on things. I just don't believe that. It's cutting off your nose to spite your face, because the best trades always go so much further than you think they will. But if it's just normal trading conditions, if I'm going to scale out, it'll be like take half off and then exit the balance. I don't do multiple scales, you know, exit 3 pieces or 4 pieces or 5 pieces. It just gets messy. And here's another thing that you can do when you're tracking your trades and seeing if this works for you. That is, keep track of what % of the time you are getting better on your second half. So in general, if you are scaling out and you take half off, but then you exit the second piece at a worse price, more than 50% of the time, you're better off just getting all out. And in general, I'm an all-in person and then all-out type of person, because then I can regroup. I've got objectivity again. It makes it clean. I can be more efficient in my trading that way.
How do you define normal and above normal volatility for a given market? Do you ever not trade certain markets based on too high or too low volatility?
Oh, I've got a good one for that. I wish I had my box of cookies. Somebody showed me a chart one day, and it was correlation with a slow market day and really low volatility, and that was the day that the box of cookies got eaten entirely. So, you know, if you find yourself eating too many cookies, it's a low volatility market, and you probably shouldn't be trading it anyway. It depends on normal and normal volatility. What I do to define my volatility for a market is I calculate out on a monthly basis, the dollar average range. So for example, if the S&Ps have a 20 handle average daily range, okay, that's going to be $1,000 range. And I adjust everything by the dollar range. When a market gets too low, for example, corn sometimes at certain times of the year is just too low, I'm not going to trade it. But there have been times where the dollar average range in corn has been much greater than that of the S&Ps, if you can believe that. I can think of 3 periods in the last decade where the dollar average range in corn exceeded the S&Ps for at least 6 months at a time. So that's about the most objective way that I do it. There's no such thing as too high of a volatility. You just cut back your size. When the volatility is super high, that's where the opportunity is, as long as there is liquidity. Okay, so you have to have liquidity and volatility, and then those are your ideal trading conditions.
How do you backtest full system or simple probability?
Okay, I'm assuming that the person means by full system, I initiate, here's my entry, here's my stop, here's my trade management function, etc. I do a lot more modeling that's simple probability. In other words, here's 2 variables, here's 1 filter, let me grind it out and see what the general edge is. And when you do that kind of modeling, generally you will find that things model out best without stops. So simple probability could be saying something like, you know, if there's a 3-bar breakout and or let's say there's a 3-bar triangle, or just make it an NR7 for simplicity's sakes. And I bought the high of the first hour's range if it takes out the high, and I exited on the close, or exited on the close the next day, or exit on the close 3 days later. What is my result? So I don't really have any tight management. I don't have a stop. I'm just trying to see what % of the time does it then trade above that high the following day. In other words, what is the odds that there is going to be follow through? And that's a pretty important question, because if I'm looking to capture a trend day and I'm in during that day and the price is trending and I've got an increase in volume and an increase in range, it's really important for me to have confidence that we have a pattern that we can have follow through the next day. It doesn't mean I'll necessarily hold it overnight, but I'll be much more inclined to at least hold that as close to the close as I can without seeing that there's some, you know, real stalling or divergence up there. So when you do catch a tiger by the tail, you really need to hang on to it. And even if you're a day trader, okay, just knowing that there's pretty high odds that will go higher the next day or lower the next day, is it going to at least keep you with that move throughout the day?
Okay, I'm just reading these as they're written, so sometimes it's a little tricky. Okay, how well does the size of a bar's range correlate with volume? Has she done studies on this? If so, has this changed over the years?
To the best of my knowledge, it hasn't changed over the years. I would just say that probably 90% of the time the day is going to correlate, the range is going to correlate with volume. So let me just give you an example here. I can put up a stock for you. And stocks might be different than futures. And there's a lot of little funny things, such as obviously contract rollover and so forth and so forth. You can see though here, June's the front month contract here. We don't have an expiration. And of course we had a super big bar, and of course the range expanded. And then we have a lower range and narrowing volume. I would say 90% of the time, and the exception is there will be times at the end of a swing up or the end of the swing down where the range greatly contracts and we have even bigger volume. And that's usually an accumulation or distribution point. But that's just a pretty good generalization.
How do you use HFT information inputs to trade your intraday strategies?
Wow, HFT. I am assuming that somebody is referring to high frequency
trading, right? Information. Mm-hmm.
I ignore all that. It has nothing. It has no impact on my trading. You want the higher. You want that high frequency algos to be running in the background. Trust me, because they provide a lot of liquidity. And if you've ever been trading in extreme uncertainty when they have been turned off, and there are manual overrides on these where people monitor these systems and they do have the freedom to flip the switch and turn them off, you will see prices spinning so fast it'll make your head spin. And by that I mean it'll spin up 12 ticks and then down 12 ticks within the space of a few seconds. It's no fun. So I really am grateful that these algos are there. And if anything, you have to keep in mind there's three different types of algos. There's the execution algos that, you know, large institutions and funds will use to execute size volume. And so, for example, if I wanted to go and buy 10,000 S&Ps, for example, I'm not going to go buy 10,000 S&Ps at the market. And I'm giving an extreme example. I would say, buy me X quantity over a 10-minute period, work half on the random bid, take, you know, at random time intervals, you know, take half, you know, at market at random intervals, and you mix it all up so that basically you end up getting an average price. And that goes on a lot. Same thing with the iceberg orders and all kinds of things that you really can't see. So I don't look at the book. I don't look at the size. I don't look at any of that because from my experience, you know, as a CTA and stuff, it's a pretty moot issue. There's no transparency there. The second type is going to be more the market maker algos, where it's the constantly are working the bid and offer throughout the day. This used to be a very lucrative profit center for many firms. It's not so much anymore because too many firms started doing it and they're fighting with each other, but there still is a bit of that going on. And then lastly, you have an increasing share of the strategic algos, if you will. For example, if there's a little low volatility point, have you ever looked at the volume that comes in around a previous swing high or previous swing low? And I'm talking about swing highs and swing lows on even 15-minute charts. You'll see a huge increase in volume right at those points. Sometimes it's a legitimate breakout, and other markets, they're very noisy. It'll goose that market up, you know, point, 2 points, whatever, and then it can come right back down. So if anything, they have increased the noise level in the markets, which can be good or bad for a trader. If I do have offers out there to sell above a swing high, maybe I'll get filled. You just have to be really careful not to be reactive in those cases. But in my opinion, I appreciate the liquidity that they do add.
Okay. How many markets do you think is optimal to try and focus on and actively trade at one time?
I think that totally depends on if you are day trading only or if you are running more of a system or strategy. For example, a strategy might be that you have quantified hourly bull flags. While you might have 2 or 3 working in a market with hopefully automated trade management functions, and then you are free to make trades in other areas. For me personally, I start to get into trouble once I have more than 5 or 6 positions on. I am going to overlook something, I'll get sloppy, I'm exiting at less than optimal spots. If I'm trying to tape read a market, which I really enjoy watching the S&Ps on those tick charts that I showed you, I really can only do that well on one market at a time. So it really depends on your trading style, but for myself, even with stocks, even if I have stock positions on, I pretty much will do well if I'm just working 3 or 4, and that's with a time duration under 2 to 3 days. You know, once you start looking out in your horizon, your time horizon, you know, you could easily, you know, manage a portfolio of 10 or 15 positions just fine.
Why is it so challenging to follow through with my analysis?
Oh boy, okay. Well, not knowing what your analysis is, I'm just going to go by the fact that all of us, you know, can make a game plan at night or a business plan at night, but there's still a lot of noise and uncertainty that happens during the next day. And the more information that you allow into your decision-making process during the next day, the more confusing and noisy it's going to get. So the first thing to do is, if you had a game plan and you feel that your analysis is good, don't put so much emphasis on the outcome of that analysis. First, just get the confidence to pull the trigger in the first place. So if your analysis says to, for example, look to short the S&Ps on a morning push up above 2850 area, which was sort of a previous swing high this morning, and that's your initial analysis, try making a short trade, but it's okay just to pull the trigger and then say, no, this still feels a little strong, and scratch or get out of it 1 second later, because you're never going to make money if you don't even try putting on the trade in the first place. So sometimes what we do is we put so much work into the analysis that we expect to be paid off for it, and you can't go about trading that way. You have to be a little bit more flexible. I have to say that experience counts a lot. So you will gain confidence the longer that you're in the market. Always start off with the smallest contract size only. Don't stack the deck against yourself by putting on too large of a trade and having these expectations for it. Lastly, trading and technical analysis are two entirely different things. They really are, because trading also has a lot of components that deal with emotions, and it's very difficult to go against the crowd and go against the herd, and it's very difficult to do things that feel unnatural. And somebody made this great comment about how you could take a newer trader and just about make the opposite of all their trades and make money, because they're usually going to be taking action at the wrong spots where you don't necessarily want to be taking action, if that makes any sense. So it's okay. It's okay to do good analysis, but maybe it hasn't translated way down to your bottom line yet. And all I can say is that keep record of why you're making the trades, and psychologically, if you're in a reactive mode or a chasing mode, or are you chicken? You had a spot that you were looking at to buy or sell, and maybe it doesn't feel very comfortable when the price gets down there, but it turns out to be the right thing. You know, go buy a call option or buy a put option instead of putting this pressure on yourself to make a big leveraged bet, and at least you're sticking your toe in the water.
Of those traders who wanted to make their living on trading or investing, what percentage have successfully accomplished this? What is the most important factor for their success?
Oh my goodness, I have no idea whatsoever, because I have no idea how many traders want to make their living. I would say that 99% of them want to make their living trading. Everybody would. And what percent accomplish this? I can tell you a statistic that I heard from a study that Revco did when Revco was around many years ago. And I know that this statistic has stood the test of time. Because I have confirmed it with other FCMs at different periods in the past. And that is, if you took an FCM is a clearinghouse such as TradeStation, MF Global was one, or RJ O'Brien, these types of firms, and you looked at their accounts, 10% are profitable, plus or minus 1 or 2 percentage points, okay? So that tells you that in general, 90% of the trading accounts out there are not profitable. Of that 10% that are profitable, what percent of those are actually profitable enough to be paying their bills and making a living? Okay, so you see there's a big difference between being profitable versus making a living from your trading. And I would have to say that, in my opinion, maybe 3%. And that's like saying, you know, what percent of golfers out there are going to make it on the professional tour? Maybe 0.3%. You know, what percent of rock bands out there are going to cut an album and make money off it? Maybe 0.3%. So you're up against some very challenging numbers there, but there's hope. First of all, it's a wonderful, wonderful hobby. You can still make money, all right? I don't know if you're going to make enough to put your kid through college and do that kind of stuff. But it's still a wonderful hobby. It's an ever enjoyable game. The second thing is the most important factor for success. If you want to make a living doing this, this is very, very important. You need to come up with your own system, your own methodology. You must have a concrete methodology. All right? You can't be sitting there following people on Twitter and looking at blogs and buying indicators and being in chat rooms and stuff like that. That might be fine for a little bit of an initial learning process. There's nothing wrong with getting ideas from other people. I have a hard time believing that the trades that you see on Twitter are the only trades that these traders make. All right? Sometimes you see people posting trades, and trust me, I know some people that do. They're not posting the other 100 of losing trades that they're making or when stuff isn't working out. So I think you get an overinflated idea as to like how wonderful and easy it is. It's not. But I really think that the people that I have seen who have been able to do this for a living devote a tremendous amount of time to their preparation, to their game plans, to the modeling. Let me give you one example here. This is just a real quick fun example. Bob Buran is a good friend for many, many years, and from him I learned this volatility breakout system that I actually wrote about in my Trading Sardines book. And it was something that was sort of modeled after Larry Williams' initial foundation that he did, or Toby Crabell, with initiating a position after the range expansion. Bob still trades this every single day after 30 years, but he does it on stocks now. But the system worked well on futures, even though it's a pain in the butt to trade. And so Bob only does this. He has only done this system, which he developed, for 30 years now, and that's all he does. And it's his game, and this is his game that he plays every day. And he has told me that he has sold his system to thousands of people, and it's a good system. It's viable. And he says, you know what, Linda? None of these people can trade the system. It's not a difficult one to trade, but they don't believe it because they didn't develop it. So the people that I've seen that do make a living do something that is scalable. They become very, very proficient in their particular methodology. It doesn't have to be a system. It could be market profile work. It could be a seasonal program. But learn to specialize in one thing and then do that well. So that'll be pretty key to your success.
Okay. Who let the dogs out? I'm sure you guys heard our dogs. All right. Now let's see. How do you get back on track mentally after losing periods or unexpected drawdowns?
Oh, my goodness. Let's see. I have had 5 million of those. I tell you how I get back on track in my book, because every chapter is about me getting whacked or blindsided, definitely having unexpected drawdowns. But here's what I do. Okay, you know that it's part of the game. You know that either the market's going to blindside you with some unexpected event. There are tape bombs that happen out there. That means that some unexpected news on the tape. I mean, it could be a nuclear reactor blowing up. You know, we've had a flash crash. This is the business. You are dealing in a business of risk. And so generally the people that do the best understand this. They understand that you're dealing with risk and you can't control it 100% other than making smaller leveraged bets. So it's easier for these people to get back on track mentally because they know that these losing periods are part of the game. Every large CTA or trader out there, myself included, and I'm talking Paul Tudor Jones, George Soros, Louis Bacon, you name any big name out there, and they have had a losing year. Okay, it's just the business. We can't be on top of our game all the time 100%. There's a lot of variables out there. It could be a trading environment that just does not favor our particular style of trading. So here's what I do. First of all, you have to understand that time heals, all right? If you just back off a little bit, walk out of the office, take a day or two off, you need to get your objectivity back. Number two, you cannot trade well when you are stressed out. You are going to make faulty decisions. So do something and be nice to yourself. Go get a massage, go to the beach, treat yourself well, do something to help alleviate the stress. Go to the gym. I'm a huge believer in doing something physical, okay? You need to get it out of your body physically after you make a screw up. Then when you feel like you're calm again and rested again and you can come back in with some objectivity, a lot of times we end up making back our losses in different markets. So don't try to get even with the market. Don't think that, oh gosh, you know, I lost money on the S&Ps trying to short it all through the end of January, thinking that we were going to do a retest down and we didn't. And now I'm still looking for that shorting opportunity. You have to free yourself from that. And that's why it's also really important to come up with a methodology or a structure that allows you to make trades from the long side or from the short side. Okay, so then what I do is I try to make a feel-good trade. I need to find that one opportunity where I can convert and get the wind behind my back, and I'll usually do it on the smallest size. It's a test the water trade. And I'm just waiting and watching and watching and waiting for that one spot where I know I can make a 90% trade. And even if it's just for 2 ticks, it's like, yes, I'm back. Yes, it was a winning trade. All I care about was it a winning trade. I might have lost a ton of money, but I just made a winning trade, even if it's $10. So much of this has to do with how you frame it out in your head. I have a lot of positive thinking books and motivational books, and I immerse myself into that. I mean, maybe you need to go and pray, you know, whatever it does it for you to get confidence and faith back in yourself again. But it is tough, but it's, you know, it's part of the business and everybody does it.
Okay, this one is from the room. I'm scared. What is that creepy thing on the screen?
Oh my God, I forgot. I didn't realize I had that up. Oh dear. Okay, that is Raffles. Raffles I found in Singapore, okay? And this is actually my trading icon in my office. And yeah, so he was my good luck icon that has hung above the door in every office I've had, and I should get that picture out of there. I will put a much more interesting picture up for you. But there's a funny story about Raffles. It happens to be in the book, and I'm not going to spoil it for you. I'll put a cute one for you there. Okay, that's NASDOGgy. That's he was literally named after the NASDAQ index. So NASDOG is my nickname. And just for more fun, this was the other thing that we had hanging in our office. This is a stock selection board that Nigel had gotten in the mid-1980s. And the funny thing about it is that half those stocks no longer exist. They all went under in the financial implosion that we had. there in 2008 and into 2009. So that's a little bit more humorous for you. Sorry about that.
You see what I have to live with? Okay. All right. For a short-term trader, day or swing, with a starting equity of, say, 100,000, could be 500,000, how do you create a plan to put it into work? Do you put it all in one strategy or multiple strategies? And how many is too many?
That's a good question. You know, that would be a really fun thing. Let's take $100,000 account, trade it live online, and see if we could run it up to $1 million, huh? That would be a real challenge. I bet nobody's done that before. That would be really, really interesting. That would be a buttload of work. Talk about pressure, huh? Okay, I got to think about that one. Well, here's what I'll say. Okay, say you've got your starting equity of 100,000 and you're a short-term trader. How to put it all to work? Now, that is a little bit tricky because when I'm managing money, and as a CTA, you want to look at your margin to equity ratio, okay? So it's not a really great thing to be trading with 100% margin, obviously, okay? Even 50% margin is way too great, obviously, you know, especially when you start adding up, you know, having 6 consecutive losers in a row, which is just about a given. So with 100,000, I'd try to see what combination of contracts or size leverage would be keeping it around between, say, 15 to 25% margin is a very viable amount to be putting to work. Do you put it all in one strategy or multiple? Well, let me answer that. Again, my friend Bob Duran had a account of $80,000 and he was trading 4 lots in multiple markets. So with his volatility breakout system, he could be having positions on in, say, 6 or 7 markets at one time. And he would do either 2s or 4s on everything. So it really depends on what your strategy is. A volatility breakout system is a very mechanical, systematic thing. If you were doing something like a seasonal program, Steve Moore runs a seasonal program, and he gives a recommended amount of you know, dollars that you would need in your account per each contract that you trade. Let's say that you are doing nothing but eminis and you are just strictly day trading off of my seductive little tick charts. Okay, so let's say that we're sitting here and each day we know that we might get between 2 to 3 trades a day that are from a well-recognizable pattern. Here's a 4,000 tick, and right here in the middle you can see a very clean bull flag type of thing. So let's say it's very realistic to be looking to make one trade, and of course this is also Globex data, so I'm not suggesting that you'll be able to trade this around the clock, but you will find that there's always 2 or 3 trading opportunities per day. And let's say that you can capture 2 of those or 3 of those, and you have a win-loss ratio of 66%, you know, that type of stuff. There's nothing to say that you couldn't be doing, I would say, 6 E-minis per 100,000. That sounds really, really conservative, but I'm talking about if you're being very systematic. When you are good and you've gotten much better in terms of your consistency level, there's no reason why you couldn't trade 10 E-minis. It's all going to be a function of your comfort level. How good are you at your risk management? How much of a cushion do you need psychologically? But whatever you do, put it in terms of a unit level. So that's what I do. If I say, let's say I've got a $100,000 account, I'm going to trade 1 unit, or rather 1 contract per $20,000, and then that's 5 lots equals 1 unit. So then I can stop thinking about the actual size. I can say, okay, I've got 1 unit of S&Ps, I've got 1 unit of corn, you know, I might have 1 unit of gold, but if it's really volatile, it might only be 3 contracts. So I make everything a unit size according to its volatility. I know that's sort of a roundabout answer, but that's a pretty open-ended question. How do you create a plan to put it to work if you're a short-term trader? Obviously, to create a plan, you need to have a very concrete methodology. People got to think this out. What is your methodology or style? It takes a lot of work to find out what's going to work for you. You know, are you day trading off tick charts? Are you doing longer term breakout works? Are you looking for 2 to 3 day swings? And sometimes people underestimate how long that learning curve takes. And they start jumping around. Let me try this week, and let me try this week. And oh, this person's doing market profile. Let me follow them for a little bit. And oh, let me do this course. And oh, let me do breakouts from Bollinger Bands. All of that's okay. That's all part of the learning process and trying different things. But you're not going to make money doing that. You need to say, okay, I've tried all these 10 different styles and these indicators, and I've seen what other people do out there. Now let me narrow down to what I feel most comfortable with and what I really want to concentrate on. Okay.
How many markets do you think is optimal to try and focus on and actively trade at any one time?
Well, I already answered that question. You know,
good.
Start off with one market or two markets, and you know, you'll find your breaking point pretty quickly. Everybody can process information at different levels. Some people just do best trading one market, and that's fine. There's nothing wrong with that. I like to have a stable of a couple choice markets. I've always had the S&Ps and the bonds in my stable. Those have always been markets that I'll make a trade in every single day. And then it kind of depends on what else is really moving or hot. You know, if the crude oil market's really good trading, or perhaps the euro currency is really good trading, you know, I'll try to go where the action is.
Okay, let's see. Do you trade the Globex hours? And if so, which markets are they?
I do trade Globex. I love trading at night, and it's not necessarily trading. That's when I like to put positions on, because I always start my day after the market closes. And so I sit down in the evening, and that's when I'm doing my preparation. I can see, oh, a buy day's setting up. Like, for example, this morning coming in, half the move had already played out in the S&Ps, but you could see on the close yesterday, the way we closed, that today was going to be a buying day. So sometimes you can go in and initiate a position in the evening. That might not be for everybody, but I don't mind putting on positions in the evening. And it doesn't always work out. I mean, there's a lot of times where I wish I hadn't stuck my nose in a market at night. You know, but that's usually what I'll do. And I really like trading the E-minis early in the morning. When I sit down at my desk, it's 8 o'clock Eastern time. That's the start date of my day, and I'll show you why here. Let me see if I've got a good chart here. I actually did make something for you somewhere. I'll find it. The reason is because that's when New York used to sit down and trade the bonds. So here's a good graph for you. What I've got marked off here is these orange dots here on each of these markets is that first 7 a.m. bar. And that's what I use as the start time for my day, 7 a.m. And you can see here that the DAX at 7 a.m., that was pretty much the low for the day in the reading. Now the S&Ps had a little down push off of that, but then they rallied up off of that. The bonds, remember how I said the bonds, 7 a.m. Central Time is very often an inflection point, meaning a change of trend for what had been happening since Europe was moving. And pretty much every day, about half the markets will trend off of that 7 a.m. reading, and half of them will do that open, test, reject, rotate type of pattern that Jim Dalton spelled out in his first book. So we did that with the S&Ps. We opened, and then we traded on both sides of that early morning range. That is what I call a Z type of day. So what I'll do is if I see a good pattern in the DAX, for example, a lot of times there will be a bull or a bear flag as the DAX is still having continuation from its early morning trend. Okay, so this was a 5-minute chart of the DAX this morning. And if I see a good pattern on the DAX, there really wasn't so much right here. It was pretty much a straight markup. I don't mind trading the S&Ps with the confidence of that pattern. So I hope that helps. It's something that you guys can look at. And even if you don't have the DAX per se, you don't want to pay for Eurex data, you can see charts on the internet that are there live and streaming. And even if you have a platform that doesn't have timely Eurex data, a lot of them will still give it to you on a delayed data. But you can just Google around on the internet and you'll find the basic idea of what the overnight markets, how they're moving.
Well, this is an easy one. Where can I get your new book?
Oh, that's a plant. You planted that question.
No,
yes.
Actually, there's a couple of them.
Oh, really?
Yeah,
oh.
Right. I mean, live ones, probably about 5-6 questions.
Oh, okay. This book took me 2 years to write, guys. It was the hardest thing in the whole damn universe. You think that trading's hard. I think that writing is hard. So this is, it really took at least 2 years. And it's on my website. So if you just go to lindaraschke.net, you can find it there. I'm not listing it on Amazon. There's no Audible or Kindle version, and the reason is because it's a work of art. I had Reuters Thompson publish it, and I put it on the finest paper with a linen cover, and just I like books on my shelf, so I want it to be pretty that you could take off and and open it up anywhere and laugh at the funny pictures and my horrible charts of all my horrible experiences that I had. And it's really a fun book. If you go to my website and you click on the book, you can go and read the first chapter, and you can see an outline of all the chapters in there, and it'll give you a pretty good idea of what it's about. Okay, next question.
1 second. I think you've kind of answered this one. What hours do you trade, and what are the best times to trade? I think you kind of...
I probably trade too many hours. That's my problem. That's not always a healthy thing, believe me. The best times to trade are around the session openings. So the best times to trade are in the morning session for the S&Ps. I don't trade Eurex opening, but that's a great time to trade too. And in the evening session after Asia opens up, that's really, 9 o'clock Eastern time. You'll always have a little bit of play there in the markets, and then they sort of go dead again until Europe comes around. But if I had to pick just 4 hours of the day, it would be 7 a.m. to 11 a.m. That's Central Time in the morning session. That's where the opportunity really is.
Okay, this one's kind of also, you covered it a little bit, but what futures markets do you like to trade the most?
The ones I'm making money in. I have a love-hate relationship with just about all the markets, if you want to know the truth. I mean, I have a hate relationship with them when they're evil and choppy and noisy. I mean, I have a love-hate relationship with silver. I've had a love-hate relationship with copper. But in general, I always love the S&Ps. I don't trade the Dow or the Russell much, and I don't really even trade the NASDAQ much. I'm just an S&P person, and I'd rather trade bigger size on the S&Ps and as opposed to smaller size on the NASDAQ. I just feel like I have the best handle on it. The bonds, I really liked trading for many years, and they're just not as great of a market the last couple months, just because the volatility has been squished and they don't have the same play that they used to. But I love trading the boons. I mean, the boons, I think, are the best day trading market out there. They've got a very small tick size, super great liquidity. And if you were to compare a tick chart of the boons to a tick chart of the bonds, they're really pretty and clean. This is a boon chart here. It's kind of a high time frame there. Whoops. They're just a really nice tick size. This is a super small, tiny time frame there. Maybe you don't want to do that. But the boons, they were kind of crummy for a while too when they get in these trading ranges, but when they come to life, the flags are super clean, a lot cleaner than you'll find on the bonds, the continuation patterns, the breakout formations. This just rolled to June, so it's sort of funky, but you get the idea. Crude's a great market. It just has a really noisy time of day function. You have to be aware that sometimes in the middle of the day when the old options settle, it can have some erratic moves. And also first thing in the morning when the commercials get their hedging in, both crude and nat gas have a special little time of day function in the morning there. I like trading all of them, honestly. But I just try to pick a few to stick with each week.
Okay. You said once a good understanding of technicals are achieved, the main key is health, consciousness, focus, spiritual. Can you expand on this process?
Well, I mean, obviously you need to have good health just because it takes a bit of physical stamina to be able to sit and concentrate and not get too restless and not get too pulled in many different directions. And things like concentration, that's something that always improves with practice. I think it's hard to concentrate these days. You know, we've gotten so used to multitasking and multimedia and kids and dogs and TV and noise and barrage of stuff that we didn't have, 30 years ago when I was trading. We didn't have internets, I mean, the fax machine was a big deal. So I think it's definitely gotten to be sensory overload with one regards. But the way that you get around this, the biggest important thing, he said, expand on this process, is preparation. I mean, I have to say to you guys that preparation is a make or break it for me in my own trading. If I didn't do my preparation and homework the night before, or my plan the night before, I don't stand a chance. It's very, very tricky. I have to have a plan. I have to have a process. So, Of course, the technicals are really pretty basic. I really think that I could teach technicals, in less than a day, and you would know everything you really needed to know about technicals. Seriously. I mean, support, resistance, trend, loss of momentum, volume. You really can cover all bases in just a few hours. The next step is that you really have to study it for yourself. I mean, take the time out to print out what good chart formations look like and understand that they don't come along that often. You have to be ever so picky and discriminating and patient in waiting for those really ripe 90% opportunities where you have an edge in your favor. You just can't go banging away during the day. So I think that the more preparation and, writing out your levels, printing off a chart, circling areas that could be key areas is really important. I posted a chart to Twitter the other day. I rarely post to Twitter, but I think it was slower. It was at night or something. And I'm just not a Twitter person. I'm sorry. I thought I would try to have some fun with it, and it just kind of interferes with my process a little bit. But I thought this was funny because I posted a chart and it showed this very high volume node that the market had reverted back down to in the night markets after Friday's sell-off. And it was sort of like, okay, this is home. This is an area that's really important for the market. It's either going to be a support area or we're going to consolidate around here or play around here, for a bit. But I just wanted to make a note that this was a really important level for the market. I didn't try to interpret that it's good or bad or anything like that. And I was just curious. I looked and somebody made a comment and they're like, she just posted a chart and she didn't make any comments on it. Like what good is that, you know? And I'm like, well, that's why I don't post shit, you know? I don't want to have to deal with all these stupid, bogus comments. But I'm like, you know, there's just areas that we need to look at to see how the market trades around. It's not like we can forecast or predict or make a judgment or a value off of them. But, you know, the night before, I want to know, where are the gap areas? Where are the volume nodes? Where are the swing highs and swing lows? Where are these little points that so often are magnets in the market? And it really doesn't take that much time to do the little basic bit of homework and preparation for the next day. And that is even more important than your focus and spiritual and health and technicals and all that kind of good stuff. Do you understand? Because at least if I make a plan or a game plan or a level to watch, right? At least I know if I'm wrong, you know, at least, what is the old saying? Having a game plan is better than not having any plan at all, okay? Because if at least I have a game plan, trust me, I know if it's the wrong game plan, you know? If I did the game plan the day before and I'm like, I'm looking to short a little reaction up, and then the market is blasting up and there's huge momentum and volume, I know I got the wrong game plan. Well, it's a breakaway gap. We could just be a trend day up. That's a very realistic possibility. So I hope that that was sort of a long-winded answer. Sorry about that.
Okay, I'm going to ask a couple more, you know, from the room.
Okay.
And there's quite a bit out there, but I'm going to try to cover some of them. Okay, so what is your preferred method to identify the long-term trend on a daily or weekly chart?
By the way, I was just having fun because these were pictures from the book. Okay.
That one's gross. There you go. That's
all right. How do I identify a trend on a daily chart or a weekly chart? Is that the gist of it?
What method do you use to identify a long-term trend on a daily or weekly chart? That's really what it was.
I like looking at the swing highs and the swing lows. So as long as you're making higher highs and higher lows, that's the classic definition of a trend. I mean, that is about as classic as you can get in technical analysis. So let's see here. And then, of course, you have that issue of what time frame are you looking at, okay? I mean, not to be funky, but you could have a downtrend on the hourly chart and an uptrend on a 5-minute chart. You see, treat them as separate markets, if that makes sense. So I'm not one that puts any stock into, are we in a bull market or are we in a bear market? I think that's not relevant. It's not going to make a difference in my trading decisions. And I could be a long-term investor but still have stocks that I thought were doing well. So I don't get into those types of metrics. And even among my technical peers, you know, who have been in the business much longer than me, believe it or not, you know, they still have a lot of discussion and debate as to what constitutes a bear market and what constitutes a bull market. So I would just say stick by the, you know, dodge if you're making higher highs and higher lows. And I understand that sometimes when we make these V spikes, okay, so here is a 240-minute chart, and you can see in general on these S&Ps that at this point here, we started making higher highs after we kind of took out this little ABC up here. Right at this level, we were clearly making higher highs. On a weekly chart, I'm not so sure trend is relevant on a weekly chart. For example, my computer, we model all this stuff by these swings. Okay, so on this particular chart here of this weekly chart, my computer still says, even when we did this deep, deep, deep pullback on the weekly chart, the whole time my computer said that we are in a weekly uptrend. And the reason why is because we didn't have a lower high yet on that weekly chart. So the computer says that we are in a weekly uptrend, but how is that pertinent to how I'm trading? You see, because it really doesn't help you manage your risk. Even if you just say we're in an uptrend, you can be in an uptrend and have 20% swings in the opposite direction and crazy volatility. It's not going to help you manage your risk. And a lot of times too, some of the best opportunities can come at the turning points. So I don't do these fixed things of only take long trades in the direction of the trend, because that's not how trading works. There should be opportunity all along the way at certain inflection points or patterns. So I hope this is a good proxy. I just did a great series for Wyckoff Analytics. It was a series of 3 2-hour sessions, incredibly ridiculously reasonably priced, I think for $299, and that half of that went to the Wyckoff Foundation and Roman. And if you are interested, I will post a link on my website, or maybe I'll tweet it out to if you're interested in that. But what I did is I showed a lot of examples where we had great trades with this 2-period rate of change signaling some early momentum. I'll just show you really quickly here since I've got time. Just give me 1 sec to get this chart up here. Where did I go? 1 moment here. Because sometimes the short-term shifts in the momentum precede the longer-term shifts in price, right? Okay, I know you know what I'm talking about. So here, for example, this is just an insane example. Hogs, the hog market. Forget the weekly charts because that's contract rolls. But you could definitely say at this point on these daily hogs, this was a pretty ugly downtrend on the daily chart, right? I mean, nobody could argue you weren't just falling out of bed, and especially if you're trying to pick a bottom in this market on these daily hog charts. And we consolidated right to this nice little equilibrium point. And look what happened here. I mean, obviously there's external factors such as the fact that swine flu just wiped out 1 million hogs over in Asia, and pork tends to be one of their preferred sources of protein, right? Okay, but the signal that I want to point out to you is, look right here, and we made new 2-period rate of change momentum highs right here. So if I see a short-term reversal in the momentum coupled with price action, that to me is far more significant than are we in an uptrend or are we in a downtrend? You see? Because even within the trends, your job is to monitor these shifts in the supply and the demand imbalance. It doesn't mean it's going to necessarily get legs and last forever. And a lot of times we can have them, we can have this type of supply-demand shift on stocks to the upside and on stocks to the downside on the same day. For example, I'm going to put up, this happened on the FOMC day. Hold on here. Okay. Obviously, the financials is what I'm trying to show here. You could see this shift in the supply-demand imbalance. This was one that flagged right here where it was giving new momentum lows on that 2-period rate of change. You see, and we were breaking out to the downside. So I like these bursts of impulse and momentum to the opposite side as opposed to getting too caught up in this uptrend, downtrend concept. Where is the supply-demand imbalance? And at the same time, we did have upside moves like this. You could see NVIDIA was one that gave a buy signal to the upside. We had a bunch of these on the tech stocks. to the upside. So you had this dichotomy there, supply, demand, obviously for financials for obvious reasons, and tech shares had a good pop up. They may or may not have any more legs from here. I don't know, but it was at least a good swing trade. So I hope that answers your question.
Okay, one more, because we've pretty much had a long class here. Let me pick one more here, or maybe two more. Let's just say. Let's see, do you touch markets with which institutions don't really want to get involved in, like gold, etc.? I guess, you know, she's just talking about institutions that, markets that institutions don't really get involved with. The Dow Jones is kind of one of them. The futures, they don't really, it's not big enough.
I'll trade any market where there's liquidity and volatility and opportunity. I mean, so as long as there's enough higher time frame players, as we like to say, that could include commercials, it could include CTAs, it could include all different types of entities. But as long as you have enough liquidity, that's what's important to me. So it doesn't mean that the institutions per se are going to be trading the live hogs, and I really don't trade live hogs that often, but if there's a compelling situation there, I'm going to give it my attention.
Okay, I think they were wondering if some of those your Keltners were Bollinger Bands, but somebody asked, are those Bollinger Bands, and do you use them?
Well, that's a really good question, because you know what? I had somebody tell me that I should do some type of webinar or seminar on the technical indicators that I use. And they are Keltner channels. You can see, here's my chart. I use them on all the charts exactly the same way. So the Keltner channels are an average true range function. This is 2.5 average true ranges centered around a 20-period exponential moving average. And I would love to do a class, because I have used these things the same way for 35 years. This same moving average, these same Keltner channels, this same 310 oscillator. And I just have two other indicators that I'll use. One's the 5 SMA, and you know, sometimes I'll look at an ADX, although not so much anymore. Pretty much just price. So yes, there are definitely distinct patterns that form within this type of structure that you see. And just so you know, the Keltner channels contain maybe 75% of the price action. It's supposed to be a little bit closer to 80%. And then you can see when they push outside of these Keltner channels too. And in some types of environments, it's like a breakout trade, and you can see when the bars turn purple there, it's good downside momentum. Other times, it could be just saying that the bulk of the move is through. And so, unfortunately, with technical analysis, this is what you find. It is very important on your ability to put things into context. There is no such thing as an indicator that says buy or sell per se. It might be a buy in a certain type of market environment, but it could just as easily be a sell in another type of environment. Let me give you a really easy to understand example. A stochastic is simply a momentum oscillator such as this 310, except that it's banded, and we can see overbought and oversold types of readings. If you're in a downtrending market and that stochastic gets overbought, obviously it would be a really good shorting opportunity. It's highlighted a reaction in price. However, if we just do an upside breakout with accompanied by breadth and a breadth thrust, an overbought stochastic can actually be an excellent buy signal. So it's really important that you put these things into context. And you better be grateful for that, because if it were so easy to make a mechanical system out of this stuff, I mean, you wouldn't want that. There wouldn't be any opportunity left in the market. You have to appreciate the fact that there is a lot of variance and gray area in this, that it is not a black and white system, because if it were, it would be arbed out instantly. So that's a nice cheery thought.
Okay, well, thank you, Linda. She was terrific. She's a rock star.
He wants me to cook him dinner tonight. That's why he's saying that.
Yeah.
Yeah, okay. What other favors do you want? All
Oh,
right.
you're the best. You are the
Ah,
best.
yes.
You're sure. Okay, so here's a couple things. I'm gonna let you know that this is recorded. There's a lot of questions. You can either email me or you could email Linda. But I'd say email me. I'll get them to Linda. Not a problem, because you're probably going to ask for the recording too, possibly. Let me do this. I'm going to switch screens here for a second.
Wait, before you do.
Okay.
See, I'm just showing them where they can send me an email too.
Okay.
See the little arrow there? Contact me. Hello. And
Bada
buy
bing.
my book. Yes, it's very, very funny. It'll bring a smile to your face, I promise.
It is funny. Just skip the chapters that I'm in, please. All right. Let me do this here. I was just going to switch here for a second, and I do a small little dog and pony. Nothing big. Okay. So
thank you, guys. Thank you. I'm going to mute myself now. Thank you. Bye.
Bye-bye. So in a little bit, I'm going to bring on Glenn. Of course, that's the book. If you're interested, she told you where you can find it, lindaraschke.net. Okay. So real quick, I never really do a dog and pony on FuturePath trading. I'm not good at selling, and don't feel like I'm the best speaker at these webinars. I try my best, but by nature, I'm a trader after 41 years. FuturePath Trading is my company. It's a brokerage firm. We offer all kinds of services. We clear through 5 different FCMs, and we have discount pricing. We have multiple front ends. Of course, my favorite is PhotonTrader and TradeNavigator. And I will have to say that Glenn Larson, which you're going to hear from in a little bit, we put together a little package. I've known Glenn for, God, it's going to be like 30 years. I hate to go back that far, but it's 30 years. And he has a cutting edge platform. It's really nice. All kinds of, when you see all these indicators, they can all be programmed on there, including Linda's. And you could trade through their front end, their platform. And we actually offer his platform through 5 different FCMs, and with competitive pricing and high-end data. So here is the exchanges we clear through 5 FCMs, which gives us the flexibility to clear over 20 exchanges globally for those who like to trade Singapore or some of these other markets. So we have this offer here. We put it together. We just thought we would team up and give you an offer for those who are on here. If you open up an account with FuturePath Trading through one of our FCMs that we work with, we could give you 70 cents per side for all the CME futures, and plus the exchange fees, as well as the bottom where TradeNavigator, we have this package, and I'll have Glenn talk about the package. But the combo together, if you open up an account by the 15th, you can use TradeNavigator through us if you want to do this package, and we could give you a choice of FCMs. And it's a great deal. This is Glenn is being helpful by putting this together with me. So Glenn, are you there?
Yes.
Okay, good. Glenn, why don't you explain a little bit about TradeNavigator? I don't want to take too much time from after this, but you can get into, who is TradeNavigator, what you guys do, the things you offer, and then, of course, this deal that we have here, what are you giving them, just so that they're clear.
Okay. Thank you. Well, we're excited to share Linda with you, because I know a lot of people followed her, and so we got together and said, hey, let's do a question and answer for her. So Genesis, or TradeNavigator, we've been in business for almost 40 years. And how it got started with is I have a chemical engineering degree, and my past life used to use that, and used to see how people would look at the markets, and they would basically misuse statistical probabilities, and they would do things wrong. And that's when I was in the semiconductor industry, and we used tests and everything, basically splits, to determine if a change in our process worked. I noticed that people weren't using that same process in trading. So that was the basis of TradeNavigator. And so we've had a lot of, we do back testing. We do all the kinds of things that everybody else does. But one of the things we've done is we work with a lot of the guys you've seen on the World Cup Championship stuff. And we've had over 5 of them place on it. And even our own, we decided to put our own programmer system up against him, and he came in third. I think he only averaged 138% and got beat out by somebody trading options. But anyway, what we've done is we've looked at and worked with these traders to find out how best to model the markets and your back testing, and also how to make it easy so that people could develop their systems or their indicators without having to hire their daughter's boyfriend or the neighbor across the street to program for them. And so we've made it where it's very simple, and that's why we call it TradeSense. So what we've done is we've gotten together, and we're aware that Linda was talking today. So what we did is we said, well, let's do this. We want you guys to get the best to follow what she's done. So what we've done is we've got together our gold package. This is what we call our gold plus package. And it's our value is normally $7.95, and it has seasonals. It has advanced filtering and searches and screens. And it also has the options, what you want to do. And we have a one-on-one training and the ability to run indicators and run strategies, etc. And then we said, okay, let's stream it for you for 30 days, and we'll stream everything we got. If you want it real time, probably the Chicago ones are the best we recommend, because it's only like $18, $20 for real time fees, because we don't recommend, I hate to say this, but the New York with their $100 plus monthly exchange fees. So, and then we also got together 3 hours of one-on-one training. Now, our point here was we want you guys to focus on training, copying or learning or mentoring or learning from Linda's methods. And so what we did is we got together and looked at what Linda had taught in her book in getting ready for this webinar. And what we did is we grabbed her Street Smarts book and gathered a lot of the stuff that we found in there and assembled it. So what we're going to do is you can get the package that is the software that allows you to stream the data, allows you to trade the indicators that Linda has, and it's a whole massive $7 offer, and that's if you sign up for updating with us. So, and all you need to do is just email me. You can go to www.tradenavigator.com, grab what we call a guest pass, and then email me, and I'll set you up and set you up for the deal and get you up and going. But really, a lot of our growth has come from you guys. It's a joke that we started with is when I first started the company, people would say, well, can you add, I used to have the history, and they said, well, can you add stocks? Because all we had was futures. And I said, yeah, we can do that. Then they'd come back and say, well, can you add mutual funds? Yeah, we can do that. And then pretty soon we were getting a big database, and then we were working with some of the bigger names in software, and they kept promising to access our data. And we said, people were asking us, well, can you chart, for example, commitment of traders and our sentiment? And we said, yeah, we can do that. And then we showed it to one of our partners, and he said, wow, can you add my studies on there? And we said, yeah, we can do that. And then people start asking for streaming, and they asked for being able to trade. And all along we said, yeah, we can do that. And so that's the type in Linda at the top, so I know it's a Linda discount, so I know that you attended the webinar, and we'll get you set up. And it works really easily with FuturePath, where you can log in, and we work with, again, with FuturePath and being able to execute, and with that competitive price. Wow. We're just making it where it's going to be really affordable, and you'll be able to trade what Linda taught, and you can practice on it. And we have simulated trading, and you can get $100,000 account trade away, and it'll give you a simulator. The best thing about it, it also has a journaling feature, where after you make any trade, afterwards it'll pop up, ask you questions you want to ask about what system, what method, why you got in or why you're getting out, and it'll take a screenshot of the market exactly at the point when you made the trade. So you have the trade that you made, everything from the broker, and it allows you to review why you made that trade. Forgot that one. That's one of the biggest things that I think that traders can do to improve their trading, is simply by, it's again like anything important, if it's important enough to watch, it's important enough to journal. And that's been said by many people, that the most important technical analysis book you can read is your trading journal. So again, I'm just trying to build together a package that makes sense for everybody, and work with Damon, and that's all I got, Damon. I'm like you. I'm not much of a seller, I guess, but just trying to share where we got started, what we're trying to do, and how it works with Linda.
Yeah, well, thanks a lot, Glenn. I think it is important, part of, and Glenn, you'd probably agree, there's multiple parts to trading, right? You have to have the edge. You have to have good connections, a good front end. To execute, you need your charts, a decent, reliable charting package if you're a technician. But you also have to have a reasonable price, on your commissions, and you have to have availability to all the exchanges that you want to trade. So this was the first time I've never really done anything like this, and we just started talking, me and Glenn, and kind of morphed into this. Linda asked questions, let's do something together. So if this helps, I'm going to just put up my information now real quick here. A second.
Oh, one thing I forgot to say, Damon.
Yep.
For those that are already TradeNavigator clients, just email me, put in Linda, and we'll make sure you get the Linda stuff added to your account. I forgot to mention that.
Okay, great. So basically, this is the information here. I have been doing, I've been posting on Twitter lately, and like Linda, it's one thing you got to get used to. I also am a technician, a trader from all these years, but I do post on Twitter. That's my Twitter feed if you want to check it out. I usually post 1 or 2 charts a day if you find it interesting. And if you are interested in this package, you open up an account with us, and we'll get you set up, and then you get set up with TradeNavigator, or if you're just interested in a FuturePath trading account, down below there, Jerry Winter or Neri can help you, or you can contact me. And then again, if you had any questions that I didn't answer today, I'm going to look at them, and maybe we'll do another one of these. But you could send me your questions. There's my email, damon@fptrading.net, or you could call me, and I'll get those answered. Either that, or else if you contact Linda, I'm sure she'll get back to you. So with that being said, thank you, gang. Traders, you're troopers, because this went on a lot longer than I expected. And for me, it's martini time. What do you think, Glenn?
Sounds good to me. At least a margarita, one of the 2.
Okay. All right. Well, thank you very much. And there was a great bunch, a nice group on here. I appreciate all the questions. And we'll talk to you soon. And hopefully you'll take advantage of this package, or we'll see you at another event.
All right. Thanks, guys.
Thanks. Good night.